Hey everybody, happy Friday to you. My name is Brent Moores, and it's time for Condors, Calendars, and Butterflies. If you read the description of this webcast, it says we talk about condors, calendars, butterflies, and other multi-leg option strategies. And that's what we're going to hit up today. A strategy that doesn't actually hit up in the condors, calendars, or butterflies category, but it is one of those other multi-leg option strategies that I think it's probably good to know. And that is, we're going to talk about front ratio spreads. So we're going to do that today. So I welcome you along for the ride here. And I'm glad to see some familiar names in the chat. And glad also that I'm joined by Cameron May. Cam's helping me out today. As you have questions, if you're watching live, you can always ask those questions in the chat. And between Cam and myself, we'll do our best to get your questions answered. Now, you can follow Cam or I on X at Brent Moore CS, at Cameron May CS. Cam also has a LinkedIn account that you can follow him on. He put that in the chat as well there, so you can check that out. Hey, before we get too far into this, though, let me just mention a few things. One, options do carry a high level of risk. They're not suitable for all investors, and the material today is intended for general informational and educational purposes only. It is not an individual recommendation or personalized investment advice. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is provided for educational purposes only. And all investing involves risks, including loss of principal. There's no guarantee of an execution of a stop order that it's going to be at or near the stop price. And past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as a sole means of investment research. All right. Hey, let's head on over to the Thinkorswim platform. Take a look. This is the SPX. Little bounce day today after we've had a little rough time here the last couple of weeks in the markets, but we have had a nice little bounce today. Part of it may be more optimism from the market's perspective in terms of the interest rate, potential for an interest rate cut here coming up. Fed member Williams mentioned today that he saw that further easing of interest rates was likely, and he seems to be a more influential member there on that board. And so, if you look at the odds, what the market's odds of a rate cut they were pretty slim actually yesterday, and the market is pricing in a greater than 50% chance today. So big shift in the odds there. That may be helping to buoy the markets here a little bit. And also, hey, markets, maybe some people picking up some cheaper stocks along the way, perhaps there. So let's talk about front ratio spreads, because Chris mentioned something in the chat. Unlimited risk. Yes, that is one of the challenges of this. And so we're going to make sure we do our best to try and help mitigate the risk as much as we can, but there is technically unlimited risk on a front ratio spread. Next week, I'm planning on discussing back ratio spreads. Different. You may have heard of back ratio spreads. Maybe you've never heard of front ratio spreads. We'll contrast them. One of the differences, though, is that this trade takes on more risk. Now, there's pros and cons. We'll get to some of those pros and cons here, but there you go. So let's talk about that, and we'll put in, and that note that I mentioned just before of stop losses aren't guaranteed to execute where the stop price is necessarily. That's going to be true here on this when we try and limit our risk at a certain point. There's no guarantees on it, but I think you'll see that it's an interesting type of trade that we can look at here. So here's what I'm going to do. I'm going to just look at an example here. This is a stock that just had earnings in NVIDIA, okay? And, by many accounts, the earnings actually weren't bad. The stock has dropped significantly on the earnings. When the earnings came out, the stock initially actually opened up higher the next morning. So today's Friday. This is yesterday's candle, Thursday. They opened up significantly higher, but then they kind of sold off throughout the day. Jensen Huang, the CEO of NVIDIA, seemed to be pretty optimistic. Now, that's not always the best measure of what a stock should do. What the CEO says about the company, they tend to be fairly optimistic. But I would say the market reaction seemed more negative. It was maybe surprisingly negative there on things. So my assumption here is that is just a temporary pullback. Part of it is just that perhaps, I'm not an NVIDIA expert or anything, but perhaps it got kind of just caught up in the wash of the whole AI sell-off, AI valuation concern discussion. And so it kind of went down more because of that than because of its own, merits or detriments, I guess, if you will. So I'm going to take a little more bullish approach on that. The general trend had been pretty good. This is a 6-month chart, by the way, of a 20 and a 50-day moving average. Looks like maybe we have some support kind of in this area here. We'll see if that holds, but so far today we tested it and it's recovered fairly well. So that's going to be the trade I'm looking at. Now, let's just mention this. This is going to be probably kind of obvious what I'm going to say. There's a lot of different types of trades you can do. And this particular trade is not it's not an unlimited gain trade. It is unlike, let's say we did a long call. There's a theoretical unlimited gain on a long call. Okay. Or if we buy the stock, there's a theoretically unlimited gain if we buy the stock. Here, so it's not as bullish probably a trade as those, but it can be, unlike, say, a long call, this can be a high probability trade. That's one of the benefits of these. So what I'm going to do here is I'm going to show you the trade, and then we'll talk in a little bit more in depth on front ratio spreads and what they are. But when we talk about ratio spreads, what do we mean by ratio spreads? Back ratio or front ratio spreads? What we mean is there's going to be an uneven number of contracts that we're buying versus what we're selling. This week, we're going to be talking about some where there's more sold contracts, more short contracts than long contracts. And that's where that unlimited risk can come. Okay. Next week, it's going to be different with back ratio spreads. But why do people do them? Well, they can be time decay positive, theta positive. Okay. Time decay can help us out on those. These are Vega negative trades. So when you're looking at stocks, if you think the implied volatilities, here's my implied volatility. If you think that implied volatility is going to be going up, probably less likely to do a front ratio spread. In this case, though, we're going to say there's a decent chance that implied volatility drop, which would only tend to help the trade. We can make them bullish. We can make them bearish. Okay. In this case, we're going to make it bullish. So I'm going to do calls on this. Now, let's go here and let's just kind of look here and say, well, right now we're right about what, 183 or 5 or somewhere in there, 183. Expecting it to move more into the 190 to 200 range, somewhere in there. And therefore, we're going to look to go to the trade tab. In fact, let's go to the trade tab. And I'm just going to go out about a month here. And now the time till expiration is just going to depend on how long you want to forecast out into the future for the move, number one. But number two, keep in mind this is a theta positive trade, and theta is going to be larger as we get, to that 1 month or a little less time frame, rather than if we go and buy 3 months worth of time or something like that. So that's what I'm going to do. Now, the way I'm going to kind of teach it here isn't a universal way to do it. Just realize that. But what I'm going to teach you to do here is I'm going to teach you to buy the at the money contract. Stock's about 183. So I'm going to go to that 183 call and I'm going to click on the ask price on that. Okay. And then what I'm going to do is I'm going to go out of the money, and where we go, let me get a few more strikes here. And where we go out of the money is going to be where our max gain can be on the trade, is going to be on the trade. Now, so I can go up here, and often what I'll do is I'll look for something, maybe 30 to 40 delta. Here we have about a 35 delta. Now delta tells us how much that option is going to move in relationship to a $1 move in the stock price. But it also gives us an idea of kind of how far out of the money something is. And 35 delta seems reasonable here on this. So I'm going to go to the 195, and let me just jot this down real quick so I don't forget. So we're doing the 183, 195, and I'm going to sell two of these. I'm going to hold down my control key, okay? And I'm just going to change this to custom, and it's going to allow me to sell a couple of these. Okay, there's my spread right there. Now, if you'd like, you can go up to spread, and you can do, they have ratio spread, back ratio spreads there. Okay, you can do that, and there's none called front ratio spreads, but you can always just kind of change it there. We're selling more than we're buying. Now, let's just kind of take this as it is right now and look at it. Let me right click on this. I'm going to analyze this trade. And one of these weeks, what I'm going to do is I'm going to go through and I'm going to go to that risk profile, and we're going to take a look at what this trade looks like as it now stands here. So these can be credit spreads or debit spreads. It just kind of depends on the strikes you do. If I were to shift this from 195 to say 194, let me just open that up, then this is actually a credit here in this, okay? And this was supposed to be the buy 190. The stock right now is 183, I believe. Am I mistaken on that? 183, okay? So did I jot that down wrong? Yeah, no. Okay, so just a question on what strikes. I picked the at the money for the long, 183, because that's about approximately where the stock is right now. And I went out of the money, 2 contracts out of the money for the short, okay? Now, out of the money, and I went between 30, 40-ish delta. You can tweak these again if you like. And you see, I just went to the 194 and it gave me a credit. And in this case, if I do this, let's see, let me just make sure my dates are right here. Let me set my slices to break even. There's my break even. There's only one break even on this. If this goes against us, okay, so this is a little bit weird because we're calling this a bullish trade. And the stock right now is kind of right here. And can you see why it's a bullish trade? Because if the stock goes up, our PL line, which I'm kind of drawing over a little bit here, goes up. This is where we can see profits, okay? Let's say the stock goes down. It actually is not a problem. Our risk is mitigated on this, in this case, from the downside. Downside is fine. It's actually positive if it goes down. However, if it goes up too much, above 205.5 here, then we start to get into trouble. At first, a little bit of trouble, just like that's how trouble often is. At first, it's a little bit of trouble, and then it gets worse and worse. The more this goes up, the more it goes down. That's why if you're super bullish, this probably isn't the trade for you. But you see how, each week we talk about different option strategies. And one of the nice things about options, there's pros and cons, but one of the virtues of options, I guess, would be there's different options trades to fit your forecast, whatever that is. And so, therefore, if you're very bullish, there's a trade for you. If there's very bearish, there's a trade for you. If you're kind of neutral, there's a trade for you. This is kind of bullish, okay? Kind of bullish. But caveat is, hey, look, there's no guarantees NVIDIA is going to kind of nice and slowly move up here. It could, for all we know, jump up to $230 overnight or something like that. And so we'd be seeing a pretty big loss overnight if that were the case on that. But let's look at this. Now, in the chat, JDLMI said, so let's get out if it, yeah, we're going to put an exit here if the stock goes up. Now, you don't have to necessarily put it right here, but you can do that. Keep in mind, this before expiration, when we say our break even is at 205.50, that is at expiration. And of course, that's just, that's our expectation on that. But before expiration, that's not a break even. Do you see the purple line here? Before expiration, we'd be losing money if it goes up there. Okay? Time decay benefits us on this trade. As time decay goes up, this is a positive theta trade, we already mentioned that. It's going to get better. But so there's no necessary reason why we have to put the exit at 205.50 or something like that. It's not going to guarantee us a profit by any means, but that is maybe a consideration. We're going to consider that, okay? But let's look at the chart. Again, let's do our technical analysis. Remember, technical analysis is not a sole means of investment research. But we're saying is, at expiration, I'll try and kind of sort of draw this sort of in the right area. Right, that's about right. This is where we don't want it to go above, which is pretty close to a resistance level. So I think that may make sense from a technical standpoint. Seems like we're kind of in more of a channelish area here. Maybe we are looking at a little bounce. Maybe it doesn't do that. Remember, if it goes down, that's not really a problem necessarily. If it goes up, that's great. If it goes up a lot, that's not so great. So that's the trade here. There we go. Let me go back to analyze and then we'll send the trade here in a sec. Now, one of the benefits here is this is a high probability trade, okay? Roughly 80%. We're at break even or better. Now, a lot of that percent, in fact, let me do this. We can throw this in. That may be a little bit deceptive in the sense that, let me add a slice here. 50% of that, 50% chance the gain is minimal. Okay, we'll call it that. But still, you can see that's better than, say, a long call. A long call is not a just a plain long call is not a high probability trade there on that. All right, and now we can tweak this a little bit if we can get a bigger credit if we move our short strikes to a lower strike. But things are going to move around. So now, David said, could you buy a long call to cap the upside exposure? You could. You could. And if we were to buy a long call at, say, a higher price, do you see that? Do you see a little relationship between that and what we covered last week? By the way, for those of you who weren't aware, last week in this webcast, we covered skewed butterflies. And I'm going to put a link. Let me put the link in the chat for that. This is not for that specific class. That is for the playlist for this class. So you can go back past sessions here. And there we go. So, but yeah, let's continue with that for a sec. Let's say we were to buy one at a higher price to try and protect us if the stock goes way up. We're going to do it way out of the money, so it'll be cheaper. You could do buy plus one, for example, here. And, let's say we did it to 210 or something like that. Essentially, that would be a skewed butterfly at that point, okay? So the answer is yes, you can do that. I'm not going to do that today, but that is how you would do that. Okay, so now if I wanted to, then we can just place the trade here. All right, so 194, 183. Let me go here. And we change that to 194 on the other page. So I'm going to do that as a 194. And if I want to place this trade, I did go through, I'm not sure, Dupe, I'm not sure if I'm saying your name right, I apologize. So I showed you how to do this before. You could do it individually. You could also go and just go to back ratio and click on these right there. And then usually what you do is you click on it there, and then then you can just tweak the prices there on this. You can tweak the prices right here. So 2 ways to do it. I chose to just keep it at spread single initially, and then you hold down the control key on your keyboard and you could add in the different contracts there. If you go to back ratio, then you click on it and then you can kind of tweak it right here and get what you want there. Okay, so there's the trade. Now, we said we were going to exit because, well, unlimited risk. I'm going to say if we break above, I'm going to say our resistance around 208 there, then I'm going to get out on this trade. So let me go back to trade, and I'm going to put in, instead of a single order, I'm going to put in an order to get out. Just a first trigger sequential. You can do first triggers all. It's going to do the same thing if you only have 2 different trades here. And I'm going to right click on it, and I'm going to create an opposite order. That means every contract we bought to get in, we're going to sell to get out, and every contract we sold to get in, we're going to buy to get out. And I'm going to make this a market. I'm going to make this good till canceled. I'm going to click on the little gear on the far right, and we're going to say we're going to get out if NVIDIA marks greater than or equal to 208. Okay, and that'll get us out. That's not going to protect us from a loss. Okay, we'll almost certainly be taking a loss if we go up there, but we're just trying to prevent taking a catastrophic loss, is maybe the way you'd say that. We don't want to severely injure your account there on that. If things go south, and things sometimes go south. In fact, later in this session, I want to revisit, we did a skewed butterfly last week that went south on us. And I want to kind of show you and why we put in stops, and it didn't prevent a loss for us, but it helped keep it. I think it would have been a lot worse, but we'll take a look at that later. So there's the trade. That's a front ratio call spread there. Okay. Now, and I'm going to let that sit for a sec. We'll see if that can fill. I may nudge it along here just a little bit if necessary to get that to fill. Let's talk about these trades though, okay? So I'm just going to do a little typing here. You can do calls bullish or puts bearish. Okay, that's that. Formatting is not what I wanted there. Calls bullish or puts bearish. You have more short contracts than long contracts. Now, I did a 2-to-1 ratio. It's a ratio spread. There's more than one ratio. You could do 3-to-1, you can do 3-to-2, you could do something else if you want. You're not tweak it. The most common is doing 2-to-1, but just be aware of that. Less expensive than back ratio spreads. In fact, we brought a credit in on this example we just did. Small credit, but a credit. Unlimited loss potential. That's going to be in the case of a call front ratio spread. A put back ratio spread, it's not technically unlimited, but it is very, very, very large. So because you have short put contracts there, and so essentially very large loss potential. There's less gain potential, then I'm just going to put back ratios, spread. The max gain is at short strikes. In the example we just did, the max gain was at 205. I think that's a strike we did. We just do 204 maybe. I can't remember. 204 or 205 we did. That was where our max gain occurs. No. Not I was wrong on that. That's where our break even was. 194, I think, was where our max gain was. That's where the short strikes were. 194. There. Okay. So this is a front ratio spread here. This is a front ratio spread. More short options than long contracts here. And we just filled. Let me just move this out of the way for 1 sec. Yeah, here's the trade we just did right there. You see 194 was the call. 2 of those. 2 short contracts on that. Okay. Number 7. I'm going to say typically high probability. That's kind of a nice thing. People like high probability typically. Positive beta, negative vega. Scroll this down a little bit so you can see. And you can do various ratios there. I already mentioned that. I'm not going to rewrite that out. 2 to 1, 3 to 2. You can do any expiration, but remember your forecast. So if you're forecasting out a month, then you probably wouldn't make sense to do a back ratio spread that's much longer than that or much shorter than that either. And also remember, and theta. Time decay tends to be higher. That's something we want as we get closer to expiration there. You're going to exit on a stock target price or with target, or we're going to exit on we'll say less than 10 days to expiration. Okay, so that's kind of just like, aren't universal rules necessarily, these, some of these management rules here, but that's how we're doing them in this webcast here, just to kind of demonstrate there. Okay, and Ricebird said not tradable in an IRA account. Yeah, this is good. So let me be blunt with you. A lot of you will not be approved to do front ratio spreads, okay? But I think it's a valuable exercise, number 1, to learn more about options. Number 2, to learn more about this strategy that maybe someday will be of interest to you. And I think more you see the workings of this trade, the more it may benefit you with other trades as well there. Okay, now, exit as a percent of max gain is what Chris says. Yeah, you can exit if you've made half of what you can potentially make on this, that would probably be a reasonable exit on that. Okay. That would be a reasonable exit. So like when we look at here's kind of max gain on this, which is in this particular trade on NVIDIA. Let me get rid of this here. Is about just a little shy of $1,200. If we made $500-600, that may be a reasonable time to exit there. Okay. Now, because this is a trade that depends on kind of this time decay element from where we're at right now to there, we're counting on that time decay. So we're probably not going to get near a max gain quickly on that. It's going to take a little while. It's going to take a little while to work on those there. Okay, so there's that. Let me just kind of put this on there. If anybody wanted to do a screenshot or write those down, that's fine too. You can do that. Let's look at another example, but this time let's just kind of do more of a bearish example. So I'm going to go over here and I'm just going to do a trade. Now, so if we're going to do a bearish example, remember, we're not just super bearish, because super bearish may call more for like a long put, a short synthetic or something. I don't know. But in this case, I'm kind of bearish on this. And the reason is this. I'm looking at this, and this is just kind of technical analysis here. And I'm kind of looking at, see if I can draw my line kind of not too crooked there. That's kind of what I'm looking at on here, with potential support down here, okay? So potential support a little bit below 26. So my theory is, and you may disagree, you may think this is turning bullish, and in that case you want to do a bearish front ratio spread, but we're going to drift closer down towards the 26 level there, okay? So let's go and let's look at something bearish where it's going down maybe closer to the 26 level, below where we're at, because we're right around 27 right now. Let's use essentially the same rules, except we're going to flip it and do some puts here and make it bearish. I'm going to go to KMI, Kinder Morgan. I'm going to go out to this. Now, unlike NVIDIA, this is not as heavily traded. Now, it's still, we're still at 8.1 million shares traded today in the stock. So it's not a small company by any means, but it's not NVIDIA either. So there's probably more concerns about liquidity here in this case. So let's go to the puts. And the stock's at 27, so I'm going to go to the 27. I'm going to do the same thing I did before. I'm just going to go at the money on that. I'm going to click on the at the money. We're going to buy that. And in this case, I'm going to go out to 26. That's a little bit lower delta, but I'm going to shift. I'm going to do two of those. Now I can do this and I can do that again, 26, hold down the bid price. And no, it says back ratio. It does that. Thinkorswim calls anything you do back ratio. It doesn't even have front ratio on there, I don't think, on that. We're selling more than we're buying on this, okay? 27, 26, I'm going to right click on this. I'm going to analyze the trade. It looks kind of similar to the one we did before, right? Except opposite, right? This case, there's a 1 penny debit here. So technically, there are two break-evens on this. But I'm not that worried about this break-even, and you can probably see why. Because we're losing just $1 or so on that. Theoretically, this is the estimation on this. And of course, before expiration, we don't know what that's going to be. It's a moving target. The stock right now is up here. Stock's here now. You can see why it's a bearish trade. We want it to go down here. 26 is our peak gain. Not coincidentally, that's where our short strike is. Remember, when we're figuring out the short strike, we may kind of consider where our peak gain is. And so, does that match with my technical forecast? Well, you go to the charts, 26, this is where we're expecting it to go. That's fine. If it goes a little bit, if it's not quite there, that's fine. If it goes nowhere, that's probably okay too. It's not terrible. We just don't want it to go down too far here. So there we go. Let's look at price slices, okay? Theta, much lower theta, much cheaper stock than NVIDIA. positive theta, negative vega on that. And of course, you can do this and you can look at, and you can look at your implied volatility, and you can see if you think implied volatility is going to go up a lot, then maybe this wouldn't be the trade for you either. All right, let's go back to analyze here. And of course, you can tweak these strikes a little bit. And there, we're a little bit more limited. Your hands are tied a little bit more when you do these kind of low strike, 27, 26. There's nothing, I can't go to 27, 27 or it's not a spread anymore, right? And 27, 25 is a big difference here. Whereas if you're talking about $100 stocks with more strikes, you have a little bit more nuance there in terms of your ability to shuffle the strikes around just a little bit. And there we go. So, I think that's all I have to say on this one right here. Let's go. Oh, where are we going to get out of this? Well, remember, we could get out if it starts to go too far down. Well, let's look at the chart. Where am I going to say? I'm going to say if we go, our low was 25.6. We'll give it a little bit wiggle room below that. We'll say 25.3 maybe or something like that. And we'll look to get out that point. So I'm going to do a first trigger sequential. I'm going to create an opposite order. I'm going to make it a market order. Go till canceled. And just because we say we're going to get out if it goes below 25.3, doesn't mean it's going to get out right when it hits 25.3. It could be substantially lower than that. Okay? So let me just save that here, and then I'll get to your questions here on this in one sec here. Okay. And I'm going to send and send. All right. So let's go back to Analyze tab. So we have a question on this. Question is this. Let me just kind of shrink this down so you can see a little bit. Good question. This purple line is always below zero. How are we making money? Remember, this is showing today. Okay, this is just showing today. There's really not much, what this is telling me is there's not much likelihood this is going to be profitable, very profitable today. But look what happens if we change the date down here. And this is a little bit off the screen. So why is this not? Just change this date. Okay, well, anyway, let's go forward. Let's go forward. We'll go to December 10th. Okay, not November 10th. We'll go December 10th. Now look at the purple line. Do you see how as time passes, that purple line moves up? If I could, maybe you can see. Let me just make this a little bit more. I'd like to just kind of scroll up on this so you can see. It's not going to let me. Okay, well, hold on. We're going to try it one more time. I got to move this off. There we go. Now look at the purple line as I fast forward on dates. Okay, look at the purple line. You see that going higher and higher? That's time decay. That when we talk about theta, theta is time decay. It's showing the difference here as we change dates there. All right, so there we go. I'm going to go back to where we are today, which is November 21st, and that's where that purple line is right now. Let me see if I can get our screen back on. Hold on one sec. Let me just make a little adjustment here so you guys can see this again. There we go. Okay. All right. I'm hoping that answers your question there, Planderson. Okay. Let's go back here. And I actually didn't place those. I just put those in unallocated, but these are going to be in a back. I don't really have a back ratio group, so I'm just going to leave it right in here. So we'll look and follow those up later on those. Now, last week, we're not in the trade anymore, but we did a trade on AMD. Let's look at that trade. AMD, where's AMD? There's AMD. Do I have AMD? Last week was the 14th. This was our skewed butterfly, our unbalanced butterfly right there. We bought it for $750. Okay, 750 bucks. If you look, we sold it on the 18th for 530 bucks. So we lost 220 bucks on this trade. 220 bucks on this trade. And so where did we get out? What was our rule to get out on this? I can't tell from this page, but what I can do is I can go to order history and look at that order and go back to AMD. Where's AMD? There's AMD, and look at that exit where we got out at 530 bucks. It was saying we were going to get out if we were below $230. So we basically put in this exit on AMD. Let's look at AMD because this was a bullish trade. Where did we get? I'm going to zoom in just a little bit so you can see it a little bit easier. We got in on the 14th, which is this day right here. Let me just mark that. We got in on this day right here. We were expecting the general trend to go up. We had kind of this support level here, and we said, well, look, we're going to get out if we break below. I'm just going to draw like a dotted line here for you. Below 230. And so what happened? Well, we got out. And the reason we got out was we broke below 230. We got out on the 18th, which is this day. I think the bottom of the day. Yeah, that intraday we closed below 230. And so got us out. So we lost money. We lost money on it. But it certainly could have been a lot worse. It would have been a lot worse if we continued to hold it because it continued to go down. Now, we didn't know. It could have bounced back up and we'd have been fine on that perhaps. But in this case, that's putting a stop in. And the reason we put in stops, even though they're not guaranteed, even though they can turn worse and we can still lose a lot of money, and the stop doesn't get us out exactly where we want to get us out, very often they can help with the risk management there. Okay? All right, so that's just a follow-up on the trade that didn't go so hot last week. That was that unbalanced butterfly on AMD. So those of you who have seen that, I put the playlist for this webcast in the chat earlier. If you go back, I have different strategies that I'm doing kind of each week. And because this class goes beyond just condors, calendars, and butterflies, there's little variations on these strategies. And so right now I'm just trying to go through a bunch of them. This week, front ratio spreads. Next week, we're going to plan on hitting up back ratio spreads. And there you go. I'm hoping that helps everybody. We did do two trades, one on NVIDIA, one on Kinder Morgan. And we followed up on last week's trade. And we talked about the basics of front ratio spreads, including some stuff to maybe get you started as you look at those and play around with those on paper money. I encourage everybody to check out the Trader Talks channel. Okay, you can see playlists for various classes in there, including classes such as the Advanced Charting Techniques class, a class that Cameron May teaches. I'd encourage you, that class immediately precedes this webcast as well. Coming up next, we have market and sector analysis. Thank you all for joining me. And everybody have a nice weekend. And we'll see you all same time next week. Bye. Bye-bye, everybody.